All right. So again, thank you. Thank you. I know now we are about 30. So if you have any question regarding whole life insurance, we are going to look into that. And I'm going to do my best. I'm not an expert, like I can say, oh, I was made for whole life insurance. No, but I'll try my best given the information that I have about life insurance in particular to answer it to you. If the question is not answerable today, I'm going to come back with a feedback of the same, but I'll do my best to that regard. All right. So I think there's a good number we can get started. Drop your questions there. Then after this, we are going to have uh, a question, a question session after the presentation. I'm going to give a chance to a few people to ask the questions. But the question, what are we covering today? We're going to be looking at first the three pillars of wealth creation. Then we are going to see what can go wrong, in our lives. Then after that, what is life insurance and what are the different types of life insurance that we have? Then we go deep into a whole life insurance. Then after that, we are going to look at the structure, the key factors to consider, then how much is enough? How much do you need for life insurance? Then I'm also going to show you how you can use a trust fund to connect it to your whole life insurance for wealth distribution, right? So these are some of the things. Then we are going to look at some few questions that you will have asked me in the session. Then we are going to answer that. So feel free to visit the chat section. There are a few resources that I have shared. You don't have to buy anything. They are free resources, especially the Masterplan. You can get yours and read it through. All right, let me start by giving you a story that is very relevant to me and relevant to our discussion today. All right, so a year ago, I lost a close cousin to me. Now, this is what went on. He was over 45 years, and a wife and a young child. The child was around 2 years. And he was involved in an accident and he passed on. Now, we go to the burial and all these, you know what happens when, a relative passes on. You are required to go to the burial and all that. But during that burial session, something came into my mind that now this was the breadwinner of this family and they are gone. What will happen to this family? Yes, we are going to support, and everyone who can be able to support are going to support them, but up to what end? How long can we support this family so that they can be able to meet their lifestyle, so that the child will still go to school, so that they can have the life that this person who was the sole breadwinner was giving them? That was the biggest question. And kindly, when you join, kindly mute. That was the biggest question that we had. The wife was partially involved in the business. The business was farming. He was a very great farming guy. He was a farmer and he would pull in millions of cash. He owned assets like lorries, tractors, all that. But the wife probably did not have the knowledge and the know-how to continue with this business before she figures out how the business was running. What would happen, right? And then the thought came, if I had intentionally told my cousin about the product of whole life insurance, would life have been different? Of course, yes. And that gave me the motivation to tell as many people as possible that such a product exists, like a whole life insurance, that can come in if you accidentally, prematurely exit the world and come in and protect your family. But too bad, I had not gotten a chance to talk with him about the whole life insurance. That would have changed the whole family's life. But today now, I'm going to give you this information. You see, in life, one thing is permanent, that we are all going to exit this world. We all want to go to heaven. Well, that is good. We all want to go to heaven. But the question is, when are we going there? And when we go there, how will we leave the people who depend on us here on earth, right? Because we have seen that when a breadwinner, when one member of the family exit, let's say they go to heaven or they go to the destination they wanted to go, things can go wrong. And a lot of things go wrong. What are these things that can go wrong? Families are reduced to beggars overnight. A breadwinner who was bringing in a salary and income to that household, then they exit, the family is reduced to nothing. Let me give you a case example. Do you know if your husband or your wife, they have money in the bank, you cannot be able to access that money if they are gone. You as a wife, you cannot be able to access those millions in your husband's bank account when they are gone. It will require you to go through, the court, the succession way for you to access. That means if you did not have something in your bank, you can sleep hungry. At the same time, the bank is full of millions. All the assets that you have, you cannot be able to sell them until the succession planning is done. That means if you exit before everything is in order, your family is likely to become beggars overnight. Something else happens. The stable investments, let's say there's succession planning or you had joint, properties, you had joint investments. Whatever is there, because now the income is no longer coming in, you have to sell it. So land, stocks, long-term assets, they are liquidated because people need to survive. That means all the wealth that you had accumulated is gone because your people have to live. They have to sell off these things to get cash for them to survive. Your children might struggle to meet even the basic needs. Let's talk about the education. Who will pay the school fees? The lifestyle that you wanted to give your children, who is going to attend to that? No one. If it's not your wife, who else? If it's not your husband, who else? And they must have the capacity to do so. And this capacity can only be expressed in terms of money. Creditors will come to attach your properties. Creditors are ruthless. I know currently we have, credit insurance from the bank. If you have a mortgage, you get mortgage, life insurance, because the creditor also know that this guy or this woman, if they exit, we cannot be able to recover our cash. And if we recover our cash, we are going to go into this guy estate and attach the properties, the assets that were guaranteed. Now, if you had taken a few debts, the debt scandals that we are experiencing, they are humongous. Now, if you had a few debts here and there, they are going to come for your family's properties, family assets. So, creditors. Now, another one, funeral expenses. You know how it can get expensive. Your people, death has no notice. When you are exiting to go to heaven, heaven is a good place, but it never notifies you that tomorrow I'm coming. So, most likely, it will come when you are not ready, when you don't have an income, when the family is still struggling with debt and all other responsibilities. And now, when it comes, funeral expenses. Now, that is where we have WhatsApp groups. That is where we we rally all the family members and the whole community so that we can give you a decent send off. That can also go wrong. Now look at it this way. You are a single parent. You are the one supporting all your family. And now you exit. Who do you think your children will, who do you think will support your children? No one. Remember, now your children will be divided among the members of the family. These family members who you are supporting cannot be able to give your child the best life like you had envisioned. Now remember, let me tell you one thing. Your brothers, your siblings, brothers, sisters, even your parents, they love your children so much. They love them. But note this, if you exit, they might love them, but they don't have the resources to give them a good life. That means one child will be shuffled from one family to the other. Others will go to, uh, to shelters to get a life from that. You don't want to disrupt your family. And this happens. And when they go to the relatives, they don't get the best life. I promise. They don't get the best life. Now, another thing, if your spouse was a stay-at-home, they were just raising the children, or probably they did not have a job and you're okay, you had an income coming in. What will happen is now they have to get into the job market and just find a survival job. These jobs are low paying and stable work. They don't have even dignity, but they have to survive. They have to feed the children. These are things that can go wrong if a breadwinner exit prematurely without a concrete plan for the family. Right? If you had a business, it can collapse. Probably have noted that most family businesses probably is a wife who is running the business. The husband has no idea. If it's the husband running the business, the wife have no idea. So if they exit, that business is no more. By the time the wife or the husband are, they are catching up with the business, they need money to survive on. They need school fees. They need rent. They need to support their lifestyle. That one is not there. Here's another one that drastically change even the relations of the family. Relatives wage bitter inheritance battles. We have seen it. You have properties, you have good money in the bank. In fact, you have already created a will. Very nice. But immediately you fall down, your relatives are there. They demand their share. In fact, they're telling your wife, these properties belong to our brother. You have no shareholding here. How can you sort that when you're still alive? There are ways you can do that. One is life insurance. The other one is trust funds, right? That is why we're having this conversation, because we have seen it. It's painful, but we avoid it. Out of all these problems that can come from that, there's one thing that is permanent. Poverty, generational poverty sets in. When your family gets from comfort to a life of begging, a life of financial instability, poverty sets in. They don't have a choice in life. They get bad jobs. Your children don't have the best opportunities. Health-wise, no one is taking care of them. In fact, the respect that your family was given when you were alive is no more. Because where there is no money, there is poverty. No one will respect a poor man. That is how the society is. Another thing that can go wrong is you're seeing that most people, before the exit, there's usually a very huge medical bill. There's usually probably a critical illness that comes, things like cancer, kidney failure, all these critical illnesses, they come and demolish all the financial structure that you had set. All your investments, you liquidate them. Every asset you had, you sell it to go to India or any other country to get medication. By the time this guy or this lady is exiting, the family is already in a negative. That means automatic poverty. By the time they are figuring out on how to pay the medical bills, things are not working. You saw the other day from the news, the government was intervening a person, body who's, the hospital had declined the family to go and bury because they did not have money to pay for the medical bills. These are things that can happen. Let me tell you, my friends, sometimes we go in life thinking that everything will go right. And here I want to introduce three things. When we are talking about wealth creation, and when we are talking anything about wealth, one of the critical area that we usually focus on is wealth creation. How do I multiply my wealth? How do I save more? How do I create my pension? Which investment is giving us the best return? Is this safe? Is this preserving the capital? That is what we are mostly interested in. In fact, that is the first pillar of wealth creation. The second pillar is usually protection. Rarely do you hear people talk about protection. Why? We all hate insurance people. But during the weekend, when you go to the supermarkets or you are, even after church, some are at the gate just waiting to sell you an insurance product. But we run away. We hate them. Why? We think they are nagging. We think these guys just want money because they are interested in commission. So the protection aspect, we rarely sit down and think about it. All this wealth that we are creating, all this wealth that I'm creating, am I protecting, am I ring-fencing this wealth such a way that nothing can come in and destroy it? That this wealth can go to the next pillar of wealth creation, which is wealth distribution. That this wealth can reach to my next generation and I have protected it. And during that protection, it is where the whole life insurance conversation comes in, and also the distribution part. All right. Let me see if we have, that's the first phase, if we have some questions here. All right. I'm going to come to that. Now, one of the things that I have noticed when we are having conversation with most people about life insurance in particular is that people don't understand the difference between these types of life insurance that I'm going to give you. Now, the most popular type of life insurance in Kenya is education policies. So when you go to an insurance person and you talk about life insurance, in fact, majority of the companies in Kenya, they have what we call endowment policies. Endowment policy, what are they? Because that is one type of life insurance. But even before I cover endowment policy, let me tell you what life insurance is. So I want to make things as simple as possible. No jargon, nothing to, pluck your hairs about. Life insurance is this way. You go to an insurance company. You tell them, okay, now, Mr. Insurance, I have one problem. If I exit the world today, I don't know what would happen to my children. I don't know what would happen to my sibling. I don't know what would happen to my parents who are depending on me. If I exit, they don't have an income to live on. How can I protect myself against that? That is life insurance. You are the asset that if you're not there, the economic value that was flowing from you to people who depend on you, which is your family and any other dependent, will cease to exist. So the insurance company offering a life insurance will come in between you and your family. And the insurance company will tell you this, okay, we can deal with that. How? All you need to do is pay us something. This is something we call it a premium. You're going to pay us this premium every month, and we guarantee you that in case you die prematurely, because we are talking about death here, in case you exit, we are going to take care of your family. Your children will still continue with the life you had envisioned for them. Your family will not experience the things that we have highlighted. So you say, okay, Mr. Insurance, what do I need to do? You sign this contract, right? That is protecting you, that in case you are not there, your plan B is the insurance company. And the insurance company will come in and safeguard your family by giving them a payout that will take care of their financial needs. That is all about life insurance. It is insuring your own life against death. And who benefit in the life insurance? It is not you. It is the people who are dependent on you who benefit. Now, the most popular type of life insurance in Kenya is education policy, which is a form of an endowment plan. What is an endowment plan? An endowment life insurance plan is a life insurance with two composite functions. One function is a saving element. The other function is a protection element. So it is one tool with two functions. So what happens is, this tool, because it's acting as tool, it never gives you the best protection for your family. How is it structured? The insurance company will give you options that you can pay your life insurance, let's call it endowment policy, in 10 years, 15 years, or 20 years. Then after, if anything happens to you, let's use 10 years. If anything happens to you between now and 10 years, we are going to pay your family this amount of money. Or after 10 years, we are still going to pay your family this amount of money. That is a promise. It's guaranteed. So if you take life insurance today, and after 1 week you are off, you go, the insurance company will still pay your family the amount that you had agreed. That is where the protection comes in. And that is why education policies are very popular, because they promise you that in case you are not here, we are going to pay your family and your children will still go to school. So you protect yourself against that. That is the principle. The saving aspect is like an additional bonus, like Mr. Client. If nothing happens to you after 10 years, we are still going to refund you. We are going to give you your money back. That is why we are faced with, oh, insurance is a scam. When you look at that payout and you compare it with a simple money market fund, you feel scammed. But insurance products, the first priority is to protect you against death. That in case you exit, we are going to pay your family this. But in case you live to see the 10 years, we are going to refund you that money. And after that, we are not protecting you. In case you need protection again, come back and take another life insurance. That is the most popular endowment policies, very popular. In fact, over 85%, if not 90%, of the life insurance products that are sold in Kenya is education policy or endowment policies. So these are not investments. They are just life insurance with a saving aspect of it. That is the most popular one. The other one is called term life. Term life are usually equated to medical or car insurance. So the same concept, you tell insurance, okay, my children are 3 years, 4 years. I want to protect them up to 20 years. That in case anything happens to me between now and 20 years, you are going to pay this amount that we are going to agree to my family so that they can take care of themselves. After 20 years, they'll be grown up. They can take care of themselves. So what happens is you take a term life insurance from now up to 20 years. Then after 20 years, you are not protected. And then you don't get anything back. It expires. It vanishes into thin air. Nothing back, nothing. So, kwaheri, Mr. Client, we protected you. Leo nawaambia, thank you. In case anything would have happened to me, you'd have paid. That is term life. But there are companies, now we have some sophisticated products, some companies that in term life, after 20 years or 10 years or 15 years, the term period, in case nothing happens to you, they refund you the premiums that you had contributed, which is quite good. So this is one of the cheapest life insurance that we have. Very popular with mortgage insurance. When you have a mortgage and you hear about, I have a life insurance to protect this mortgage. That is for the bank. The bank has taken a life insurance against this mortgage so that in case you pass on, the bank is not going to come for the house, but the life insurance is going to pay the balance of the amount that you had not paid. Another one popular is credit. You have a loan insurance. After the loan is done, it expires. So you are no longer covered. Let me tell you where you can use term life. Let me give you a story. Just close my neighbor. There's a multi-million project that has stalled for 2 years. Just when this guy was about to finish the project, he passed on. And the family doesn't have money to complete the project. These are lines of apartments. There's nothing they can do about it. The bank did not probably attach the property. Why? They had a credit. If this guy had a loan from the bank, they are smart. They had a life insurance against that loan. So when the guy passed, the bank paid off. The life insurance paid the bank the balance. But now the family is stalled. They don't have the money to complete the project. So what would have happened if it were you and if you knew there is term life insurance? When you have a project, whether it's a partnership or a family project, and you're anticipating that this project is going to run for the 5 years, you can go to an insurance company and buy a life insurance against that project. If the project to completion, you need around probably 30 million, you take up a life insurance that in case something happens to you, the project will still continue, right? So you can use term life insurance for such projects that has a definite time period. That's it. So we have considered endowment policy, we have considered term life, and we have said endowment policy is what we call probably education policy. Now, the third one is last expense. This is very popular. The last expense is when you pass on, the insurance company will pay your family something so that they can be able to give you a decent send-off. That is the last expense cover. Very popular. If you're a member of a circle, probably you have one with a circle. But they are also popular. It's something that you can take to protect your family. Not here. Most of us, if a member of our family passes on, we are the one to foot the bill. And you did not sit down and discuss with this guy who is passing on that, hey, we jipange maisha yako, unajua next month, next day, I'm going to pass on. It doesn't happen. They just pass on without notice. Then the family has no money. And if you are the guy who they look up to, you're going to get the biggest chunk of this bill. So what you do, take up a last expense cover, which you can cover your parents, you can cover your siblings, of course, your immediate family, you can cover your siblings, you can cover even your, what do you call it? The other family from your wife or your husband, right? So you can cover them all. So in case something ever happens, the insurance company is going to cater for that bill, probably 200,000, 500, up to 1 million. You can take up such covers. So that is the next type of life insurance. And now the last one, which is now the elephant in the room, is the whole life insurance. Whole life literally is whole life, whole of your life. So what this life insurance does is what? It is a life insurance, the concept is the same, but they cover you from the time you take up this insurance until the last day you pass on. There is no term for it. Like you cannot take at the contract period is 10 years, the contract period is 20 years. So whole life means whole of your life. If you pass on after 1 week, that is whole of your life. After 10 years, that is the whole of your life. After 20 years, after 80 years, even after 150 years, that is when the insurance company will come in and pay your beneficiaries. So a whole life insurance is a type of life insurance that you take to protect your beneficiaries, to protect your family against your premature exit. Is not for you. You're not waiting for a time that it will mature. It is for the whole of life. And the person who benefit is not you, but your family, but your dependents. Right? So that one we have to understand very correctly, because most of the time people come and ask, hey, hii kitu nilipia 10 years. After that, I don't see this money. Yes. This is where you say, oh, I love my family. Oh, I cannot live without you. Man, this is how you can express the best love for your family. That my people, in case I'm not here, in case I exit before noticing you, your life will still continue. You are still going to pay rent. You are still going to flourish. You are still going to pay bills. Allow your people to mourn you without the financial, distress. There's a friend who was telling me that, Alex, I'm not sure why people cry in funerals. Because there are two issues. One, most will cry because, hey, our breadwinner has gone. How will we survive? There are tears of financial distress. When they remember that they don't have an income next month, they cry, tears flow. The second one is, we'll miss this guy. We'll miss this lady. They have gone. We loved them. Now, just take the mix of these two, it becomes catastrophic. Even the mourner they don't understand what they are crying. If you ask, oh, why are you crying? Hey, this guy has just left us without anything. How will we survive? Allow your family to mourn you in peace. To have some time to think about how will we restructure our lives without you. But if the next day they are thinking about how do we pay the bills, how do we bury you, how do I even take these children to school? Do we relocate? Do we sell? What asset do we need to sell? This is what happens. Love expressed financially is a whole life insurance, and it covers you from the day you sign that contract to your last day, right? So it has two key aspects. The first one is income protection. You're protecting your economic value such that if you exit, your family will not be affected economically. They will take care of themselves. The other one is liquid inheritance. Remember, if you have young beneficiaries, if you have young children, and you're the sole breadwinner, you are a single parent, or you are both of you, and one is the sole breadwinner. Between year 0 up to year 20, these people, little ones, are dependent on you. If you pass on, they are dependent on you. Their life will crumble. They are not going to get the best education. Your wife will be in distress. Your husband will be in distress. So during this time, you are protecting your income such that your exit will give them something to eat, to survive on, to flourish in life. Another purpose is to liquid inheritance. Now your children are above 20 years. Even if you're not there, they'll still take care of themselves. So they don't really need you to be there. But remember, the whole life insurance is still with you because we say it goes with you until the exit. That means now it like automatically becomes an inheritance plan. And my friends, let me tell you, the type of money a life insurance gives you, you can work, invest for the next 20 years, and you still not have accumulated such an inheritance to your people. And in that time, you're only paying 20,000 for life insurance without stress. You're not going to the bank, and take a 20 million loan to construct all these apartments in the name of this is an inheritance for my children. If you're thinking about an inheritance, and the quickest way to create an inheritance without stress, without having to take a loan, the first that we call it the low-hanging fruit. The first low-hanging fruit that you can execute is a whole life insurance. It does not give you stress. 20,000, 30,000, 50,000, according to your ability, from 3,000 to even 100,000, even 200,000, you can be able to construct immediately a whole life an inheritance plan for your family immediately. Here's a case example. Life insurance is the only product that creates wealth, like from thin air, from nowhere. Here's what I mean. Case example, you take a whole life insurance of 50 million. Today, let's use, which name? What name? Okay, let me use Alex takes a life insurance of 50 million. Today, signs, he pays the first premium, he receives all the insurance policy documents. Then, after 1 week, Alex is no more. What will happen? The insurance company is going to come in and pay Alex's family 50 million. Where did that money come from? Did I save it? No. Where did it come from? It's like it's from thin air, but that is not what happens. Life insurance is a function of pooling resources together. I know you know how collective investment schemes work. Many people come together, they pool resources in, is like, let's call it like a harambe. The whole society, 200, 1,000, 10,000 people, or even 500,000, they come and pool the resources in one pool. So that in case someone in this pool exceeds, these resources can be transferred to that person. Of course, when the insurance company gets that money, they invest it so that this money is growing and they can be able to meet these expenses as they fall due. So whole life insurance create immediate wealth, immediate inheritance, immediately. There are people who say, hey, Alex, unaongea story ya life insurance, man, I have properties, I'm building wealth in 20 years. In 20 years, I'll be a multimillionaire. So my question is, what if you don't see that those 20 years? What will happen to your family? You'll not have any inheritance to give your people. Probably you'll have saved 10 million or 5 million in 2 years' time. But when you have this plan B that can come in and just take care of your family, take care of the plan that you had envisioned for yourself, you know, as you're building your wealth, have a whole life insurance such that it's your plan B. If anything goes wrong, the whole life insurance will step in and take care of your family. Now, those are the types of life insurance, right? And now we are doubling down into whole life insurance. All right. Another thing that I want to mention is whole life insurance or life insurance is the only product, if not the only, allow me to use the only product that is guaranteed. If the promise was to pay 50 million, they are going to pay 50 million. Nothing less, nothing extra. Guaranteed. It's not like a money market fund. It's not like a bond. This is guaranteed. Your family is still going to get that money. That makes it a powerful product. No tax, tax-free inheritance. If it's 50 million, the government, no tax, the government just watches that money goes to you. There's nothing they can do about it. No tax. It's a tax-free inheritance, right? No probate. Here's the thing. We said that if you have money in the bank and it's not a joint account, your wife or your husband cannot access that money without going through the court system. Life insurance pays this money to your family. No court cases. If you said child 1, child 2, child 3, they are going to receive that 10%, that percent, that percent. No one can contest that in the court. They get that percent. Now listen to you, if you are single here and you take a whole life insurance tomorrow and you put your current boyfriend or girlfriend there as a beneficiary, then after 1 year, they become your ex. And you forget to change that beneficiary list and you pass on, your ex is going to enjoy that money, right? So, and there's nothing your family can do. They can go to court, but the insurer, we don't understand that language. This is the person who was appointed to receive this money. They give that person that money, right? So you have to ensure that the person you're putting as your beneficiary, that is the person you want this money to go to. No probate, no court cases, they get that. Then it's a perfect inheritance. All right. So that is pure life insurance. Now, another benefit that I want to add here is a whole life insurance gives you an advantage whereby you can add 2 benefits that you can enjoy, in quotes, when you are still alive. These 2 benefits, we usually call them living benefits. And one is called accidental disability. The second one is called critical illness coverage. So you can take a whole life insurance as pure whole life insurance just for inheritance purpose, just to protect your people. You are not in the equation and you understand that this money is not for me, it's for you people, right? But you can also take care of yourself. That in case you have a critical illness, these are things like cancer, kidney failure, coma, paralysis. If you have such an ailment, we know how this ailment can take our resources. So it's good to have a critical illness coverage, right? You can add it into whole life insurance. And up to 65 years, you are protected against this. Accidental disability, in case you get an accident, that means it's going to disrupt your ability to work. If you get disabled, Probably you used to use your hand. You lose your hand, one hand. How before you adjust writing or working with the neck with the other hand, the insurance company is going to pay you to your bank, not to the hospital. This amount is going to be paid to you so that you can take care of your bills, you can take care of other things that can make you comfortable. I usually call this income protection. You are protecting your income, you're protecting your investment, that you can get sick, disabled, you lose a limb, then all your investment goes to treatment. You are temporarily out of work, you don't have anything to eat, so you liquidate all the investment. So it protects those investment, it protects you, your income, and your family against the loss of an income in case of either critical illness, accident, or disability. These are not mandatory to whole life insurance, but they are additions which I recommend you adding into that policy. Now that we have understood all about that, it's good to know that from age 18 up to 60 years, you can take a whole life insurance. Age 18 to 60 years. Now, age is one of the biggest fundamental factor when you're taking life insurance. The older you are, the more expensive it is. If you can be able, if you have enough resources and your children hit 18, up to 25 there, if you can be able to lock in a life insurance, a whole life insurance for them, they are going to have a very huge whole sum assured. Sum assured is a payout, right? Then, than if they delay and take that life insurance when they are 45 years, right? So the older you are, the more expensive it becomes. So the younger you are, remember, age also, the next factor is medical status, your health factor. The younger you are, the healthier you are. Tukifika hapo 45, shida zinaanzanga. BP, arthritis, BMI zinaenda out of the roofs, diabetes. You have no idea how many clients have people we wanted, I'm desirous to give you the best cover in the industry and recommend it to you to help you process it. Then when they go for the medical test, hey, we have arthritis, we have diabetes, we are overweight, BMI, right? We have BP. So it also tells you one thing, that when you're applying for a whole life, hawananga chills, no chills. They're going to tell you, hey, my friend, your weight, go take care of your weight, or you're going to pay an extra premium. So it's good to take care of your health. Eat well, exercise, because your health is your wealth. If you have good wealth, your health, you're able to create wealth. You're able to become very productive. And also you're able to save money for medical bills. Medical bills can really eat up most of our finances. And most of the things, they come up because of our lifestyle, what we are eating, our lifestyle, right? So you can take health status become another critical factor. Another one is smoking status. What will happen? Smoking status. If you are a smoker, you're going to pay more premium than a non-smoker. So if you did not know that, know it. So that is also a very critical consideration when it comes to whole life insurance. Smoking status. So when you want probably a cover and you want to be given a quote, so they ask you, what is your age? Then medical test, anything above 8.5, sum assured of 8.5, you are required to go for medical test. So anything below, no, not necessarily. That is a list that an insurance company can take. So in case, okay, consider it like a tip. In case you have something, don't go say, I told you so. In case you have, a lifestyle disease, something that you need to avoid, you can take a life insurance below 8.5. They won't require any medical test. So that is a loop an entry point that you can safeguard your people, your family, even if you have things that can amplify your premiums, right? Or you can be okay with it. These are not limitations to taking a whole life insurance. If you have a lifestyle, let's call it, health issue, you can still get a whole life insurance, but it will be at a higher premium, right? So these are very important. Another thing that I want to mention, when you are taking a whole life insurance, kuna watu wanasema, life insurance is a scam. Wewe unataka whole life insurance. In the application form, you're supposed to tick all your medical history. Remember, if you lie, there's a principle we call the principle of ultimate good faith, that me as an insurance guy, insurance company, I believe you. There's no reason to doubt what you are telling me. I believe you. Warn to you that whatever you caused me to believe you in was a lie. Nothing will be paid. Now, if you are the guy who is involved in motorsport, skydiving, rock sliding, and you did not intentionally disclose that to the insurance company, then when you are climbing a mountain, you die. The insurance company will not pay. Why? We asked you to disclose, you did not disclose. You said no. Then now you have passed from a risk of what you lied to us. They are not going to pay. Remember, insurance is in business. Let me tell you a case example. I had an experience with medical. By then, do you have BP? No. No, we like to say no. You think this is just ticking? No. Then they have some clauses in the medical insurance, and I did not flag one clause. After everything, like 15 issues, the last one, almost the last one was, or pregnancy status. Hey, I did not see pregnancy. So we took an issue, a medical cover. I had ticked no. No one, my wife is not pregnant. And she was pregnant. In fact, she was to give, this was a corporate cover. So, they don't have a waiting period for that. So, when I was in the hospital, they said, but you ticked no one was pregnant here. My friend, they never paid. They did not pay. I was thinking that now I'm covered over 100,000. I had to pay that. I would have called them, man, you are scam. You guys are scam. But you see, utmost good faith. If you lie, they don't pay. They also lie to you, and then it becomes a scam to you. Now, that is covered. Another thing that I want to critically say here, contract structure. We say term insurance, you can pay in 10 years, 15 years, 20 years. And after that term is done, the contract expires, you are no longer covered. A whole life insurance, remember, it covers you from day one up to when you are gone, whole of your life. But now, insurance companies are coming up with a structure where instead of paying the premiums for the rest of your life, you can pay your premiums in 10 years, 15 years, 20 years, up to when you are 60 years, up to when you are 65 years, right? So you are given this flexibility to choose how long do you want to pay your premiums. Is it 10 years? All right. So you pay your premiums in 10 years. After 10 years, you forget about it, but you are still covered. Whole life goes for the rest of your life. Critical illness and accidental disability up to 65 years. If you ask me why 65 years, well, when, after 65 years, anything can go wrong. And I told you insurance is in the business. So if the probability of you getting critically ill is from 65 years, that means it's almost certain they're going to pay more claims. Then they avoid up to that level. So after 65, wewe utajipanga. But before then, you are protected, right? So up to, you can pay your premiums 10, 15, 20 years. Some will ask me, okay, so what happens if I pass on after 15 years or after 10 years after paying my premium? They pay. Immediately you are covered. Immediately. You pass on after 1 week, 2 weeks, 1 year, 3 years, the family get the payment. That's it. So another thing that I want to add into the mix is something we call bonus. Now, if you have interacted with me, I usually recommend one whole life insurance company. It's Prudential Life. This is one of the biggest life insurance company we have in the world. In fact, it's the 4th biggest life insurance in the world. Initially, they were actually almost the only one in Kenya offering a good, flexible whole life insurance where you can pay 10, 15, all those years. Now we have ICA Lion with such a policy. So Prudential Life will give you an average 2 to 2.5% of the sum assured as a bonus. 2.5% of the sum assured. If the sum assured is 50 million, is 2.5% of 50 million for every year that you are alive. It's also good to note that these bonuses are not guaranteed. They can change. It can go to 3%, it can go to 1%, it can go to 2%, but on average, they have been giving 2.5 to 2% every year that you are alive. So from first year, if you are resilient enough and you are going to pass on after 100 years, and you took this policy when you are 40 years, that would be 60 years. So 2.5% of 50 million times 50. So your family is not going to get the sum assured only. When you pass, they are going to get the sum assured plus all the accrued bonuses. This bonus, you are not paid to your bank account to enjoy. No, it is added to your legacy account, to that account for your beneficiary, right? So the next question most people ask is, Alex, how much am I supposed to take as whole life insurance? How much is enough? I'm going to give you a rule of thumb. The rule of thumb is 10x your annual salary or your annual income. Why 10x? So to get that, you take your monthly income, multiply by 12, multiply by 10. Why? It means that the sum assured or the payout to your beneficiaries, if they get that sum assured and they invest it in a conservative return, 10% return investment, every month they are going to get an amount equal to your income. That is why the rule of 10. Let me repeat that. That in case they take that sum assured, they invest it in a 10% return investment, they're going to get an amount equal to your monthly income. All right, so that is the rule of thumb. But let this rule of thumb not limit you. I usually say, forget about the rule. It could be a lot of money, but that is optimal. At least ensure that your family can have 7 years of living expenses, right? Like you take your annual salary multiplied by 7. What is that amount that you're saying? You are getting? Now you can take a sum assured equal to that amount. Or you take your budget. What is required by my family? Okay. Education, okay, lifestyle, rent they are paying, or you have a house, avoid that. This is the amount that they can require every month. Take that amount, multiply by 10. Multiply by 12, multiply by 10. That will give you an amount, gross amount. So uwe hapo. That is the amount that you can get. So that is the amount that is enough. But if you don't have that income today or that premium to pay, hey, you better have something than nothing. Remember I told you can start from 5,000. You better have something than nothing. You can add into that later. So if your income can only allow now for you to contribute 5,000, 10,000, or 20,000 or 30,000, get it to secure your family. You better have something than nothing. Then after 2 years, your income will be, you'll have gone up, your obligations will have, softened, then you can add the cover. All right. So let me go to the next. So I'm covering the critical issues, things that most of you would ask, right? Then before I take the questions. Now, the other one is, okay, Alex, I've taken a life insurance of 30 million. Hey, lakini kiangalia hivi, these guys, my family cannot be able to, these 30 million can kill them. If I give my children this 10 million, well, how nitasema by, they'll follow me. They're going to follow me next year. Remember, money is a weapon. In fact, I usually say there are people who, if you want to kill them, you don't find a gun, you give them money. They are going to destroy themselves. They are going to kill themselves. Money. So, because you know your family, can they be able to manage the 30 million? If you leave them this money, if they have never handled 1 million, how will they be able to handle that million? Yeah? Another thing is, oh, my children are at 18. If I pass on, I'm depending on a guardian who is my sister or my mother. They have no idea. I have no idea what would happen. Remember, money reveals the true character of people. You never know until you give them money. So what do? There's a solution to that. Take a trust fund. A trust fund is an account, let me call it an account to simplify things, is an account that you can open with a company, which is called the trust company, and give them directions on how to execute your 30 million. You go to the company. Personally, I usually use, I told you I'm going to give you my recommendation. I usually use ICA Milele. We also have Britam Cash Trust Fund. These are very simple trust fund. And it looks like a money market fund. Most of you, if you follow, in fact, all of you follow me. I usually say, how I have structured my education plan is I use a trust fund. This trust fund is like a money market fund, but it has an extension where they take care of the trust. Yeah? Still, you can save money into it, but they have a trust where you can add that trust fund as a beneficiary in your whole life insurance, such that when you pass on, the trust, the insurance company is going to pay the trust fund this money, 30 million, and now you'll have instructed the trust fund, when you see this 30 million, this is what I want you to do. Every month, no, you are going to invest this money, then every month, you're going to pay the guardian now. Remember, your children are below 18. The guardian, you're going to give them 200,000. That will take care of my children. Then also, the school for education. The school, the guardian is going to give you the invoice to pay their school fees. You pay the school directly. That means those commands the trust fund is going to follow. It means your children are protected. You have secured the lump sum such a way the guardian cannot misuse it. Then you can also give the instruction. When my children hits the age of 25, now you can execute this share. Give child A 10%, give child B 20%, give child C 20%, right? So when they hit 25, now they are grown up. They can have the money and use it the way they seem fit. So you have protected them when they were dependent. And you have also protected the guardian against misuse. Probably you leave the amount to your mother or father. They say, hey, this money, let me buy land and build a property that I'm going to be receiving rent. When they buy land, Kube, the land was a scam. They don't have now money. Money is gone. Your child has no money. Someone else is scared. Hey, there's this investment where you invest, you're going to get 40% return. So, this is good. You know, there are 30 million. I can take 20 million and invest here. Then the return is mine. The 30 million is still here. Why? Why collect 30 million? Money is gone. What happens to your children that you wanted to protect in the first place? Nothing. They still experience the things that we highlighted. The trouble that you are evading, they still experience it. Trust fund becomes another tire of protection. Your whole life insurance and a trust fund. So you can put the beneficiary, even if it's not 100%, 30, 20, 50, whichever amount that you need, at least you know that this money is secure and the trust fund is going to follow my instruction to distribute this money. These children are not going to destroy themselves with this cash, right? If it's your wife and they don't even know how to handle the 30 million, why give them the burden of 30 million? Why expose them to people who can con her? Or if it's your husband, just create a trust fund and instruct on how, because they're interested in the cash. They're interested in the cash flow, not the 30 million. If they can get their 200,000 or 300,000 or 50,000 every month, they still live. Then after that year, the distribution is done. Or probably you can say, okay, my wife or my husband, I'm going to give them their share. 20% goes to my wife or husband. Then the rest of the share, 80%, I push it to the trust fund. That means you have protected your children. You know what can happen, right? So that is a key takeaway for you. Trust fund. Another thing away from the whole life insurance, we say that money in the bank has to undergo succession. Life insurance does not go through succession. Whichever life insurance that you have, whether it's an endowment, whether it's an education policy, you can channel it into a trust fund. That also comes in for pension. Also pension, you can channel it into that trust fund. That means your children will still go to school under your control, right? Hakuna mtu atapatiwa the 30, the 10 million, the 5 million, then they eat it up. Kumbe walikuwa na shida. They were waiting for this money. And they are saying, tomorrow will take care of itself. Your children will suffer. So if you have a strategy on how you can be able to safeguard them, use these tools. Because that is what you are doing. Use these tools to protect them, right? So up to there, I think I have tackled a few. Now, before I go to the next, let me deal with some other handles, or, we call them myths or handles that people have. Life insurance is a scam. It's not a scam. It's real. So forget about it. Now you know about the details. It's never a scam. So you have to understand the policy. You have to allow that person you are trusting to give you that insurance policy these details, but now you know. If you don't know, one thing is immediately you start paying for your life insurance. Where you end up with a life insurance company, you are telling them, hey, after 5 years, I'm tired of paying the premiums. Now I want my money back. Forget about it. You are not going to receive your money back. If you had died after 1 week, they would have paid the 50 million. Why do you need money? Because you have not died. Hey, let us also enjoy the money. We protected you from the word go, such that we were holding that risk. Imagine paying one premium and you pass on, they pay 50 million. And because you have not passed on after 5 years, you want your money back. Wacha mchezo. Right? So, if you experience some problems in paying your premium, there is a solution to that. You allowed 90 days where policy is still active. In case anything happens to you, 90 days, they'll still pay and they allow you that amount. Hata kama hujalipa the premiums in 90 days, your policy is still active. So that is a good chance to fight something and bring the, pay the premiums, the accrued amount. Another thing, if you have an emergency fund, add premiums as part of your emergency fund, at least 6 months of premium that can be covered. In case you have a job loss, your premiums will still be covered 6 months. Add it into your emergency fund because this is very important. Another thing, you have no income. 1 year down the line, you are not able to pay the premium. Remember, after 90 days, no one is covering you. But after 1 year, I have gotten now a job, I have an income, I can be able now to pay the premium. You just go back to the company. If the original agreement was to pay the premiums for 10 years, they can add, you can decide either to pay the accrued, the unpaid, arrears, or you can say, hey, Mr. Insurance, kindly extend this 1 year that I missed to my contract so that instead of 10 years, I'm now going to pay for 11 years. So there's no way you can lose your money. But now, if you don't come back, you are not covered. You're not going to receive the money and you're not covered. So that is very, very instrumental to understand about that. Now, the other one, does my spouse need an insurance? So I get a client, okay, me, I'm the breadwinner. I'm the one who is making a lot of money in this family, so my family would suffer if I'm not there. So you take up a life insurance. But you don't know that also your spouse need a life insurance. Because, my friend, you have no idea how much they are doing in your life. If they are not there, your life becomes darkness. You are confused. And if they were even economically contributing to your income kite, that is lost income. Look at it this way. Now look at it this way. You have a whole life insurance, you have a critical illness and accidental disability. What will happen to your spouse if they have a critical illness, if they become disabled? It means you are going to pay for it. Where are you getting this money? It's like having a medical insurance alone and not covering your spouse. We said there are families where a critical illness will wipe all they had saved, all their investment, and they are left at negative. At least, my friend, a whole life insurance at least will bring you back to somewhere. In case that happens to your spouse, and you are left with the debt to pay, bills, medical bills to pay, at least a whole life insurance will come. It's a pivot that will lift you up. You're able to pay all these expenses and continue with your life. So your spouse needs a whole life insurance. You are protecting each other. In case I'm not there, you are good. In case you're not there, I'm good, right? So does a whole life insurance mature? No, the maturity is when you pass on. So it matures when you pass on. That is when the beneficiaries get the amount, right? So that is also very important to know. So what if I pass after 1 year? Will they still pay? Yes, even after 1 week, they'll still pay. So I'm creating wealth, my family will be okay. We went through that and I told you, wealth is in future. Now what we need is liquid cash. You can have those apartments, you can have 100 acres of land, you can have even a business, but your family need cash. When you are no longer there, when you are no longer giving that family an income, they're not interested in that land. That property, by the time they are done with succession planning, they'll be in debt, they'll have sold everything they have, just even to pay even the lawyers for all that succession planning, succession process. So a whole life insurance will give them liquid cash, liquid money. Then they can be able to either go through the succession planning and everything else. All right. So I have a group life policy. I don't need a whole life insurance. Many people have told me this. Our company gives us a group life insurance. So I don't need a whole life insurance. No, my friend, that is not your whole life insurance. It's your employer. If tomorrow you're no longer working there, you don't have a cover, your family is exposed. After you retire, you don't have a cover. But when you have your personal whole life insurance, you can go to a different country, you can shift from one employer to the other, but still your whole life insurance is with you. So it doesn't matter whether you have a group life. That is your employer. When you're out of there, you don't have any policy with you. So get a whole life insurance, even if you have a group life. So I believe that is settled. Now I have a medical cover. Do I need a critical illness cover? Yes, you need one. Medical insurance will pay the hospital. It pays the bill, it pays the hospital, the doctor. But critical illness cover pays you cash into your bank. So even if your medical insurance is covering 2 million, 3 million in critical illness sublimit, they're going to pay their bills. But now critical illness cover pays you that 5 million, 10 million or whichever amount to you so that you can take care of other things. Transportation, airfare, all these things is going to take care of that. So yes, you need one. All right, up to this time, I think I've exhausted what I needed to present to you. And now I'm going to be looking at the question that you have. We said one thing, that your whole life insurance will depend on your age, your smoking status, sum assured, critical illness, and accidental disability. So in case you need a whole life insurance cover, yes, I can connect you with the best in the market. I'm not flinching when I say it's the best in the market. That is Prudential Life Insurance. So far, hands down, upon analysis, is the best. So you can WhatsApp me. I've given my details there. Go to the chat section. You're going to see, and some nice resources there. You're going to get these resources for yourself. Now, when you go to there, you're going to see different insurance quotes estimate. There is a link to that. If you open that link, it is a spreadsheet that I prepared, right from 18 years to 60 years. Let me share it with you. This one is going to give you an idea how much can I pay? How much am I expected to pay for whole life insurance? This is real data. So it looks like this. So this is a spreadsheet. It starts from age 18. You scroll it up to age 60. 60 is the entry point. Now with that, this is the sum assured. Down here, do we have 5 million, 10 million, 15, 20, 25 million, 30 million, 35, up to 40. But remember, you can take as whole life insurance up to 500 million. So these are just examples to give you an idea, right? So let's case example, you come to 20 million. You're going to see, let's say if you're 35 years, 20 million, and I take critical illness of 5 million, 5 million accidental benefit. Now the critical illness and accidental benefit, this one can change. Critical illness, it cannot exceed 50% of the sum assured. So it can be 10 million, 15 million, no, sorry, it can go maximum to 10 million. So you can have 10 million, accidental benefit of 10 million. So case example, you are 35 years and you want to pay your premiums in 10 years. You're going to pay every month 18,000. If you want to pay in 15 years, these are years, this is the term, you're going to pay 14. If you're going to pay 20 years, you're going to pay 13. If you're going to pay up to 60 years, you're going to pay 12. Now you can see the longer you have, the lower the premiums. Also note that just like a loan, the shorter the period, the higher the loan repayment. The longer the period, the more you pay. So it might look like it's less, but in the long run, if you multiply by the number of years, you're going to have paid more. So the shorter, the better. And that is why 15 is a sweet spot. But there are people who, if you can pay 10, the best. But 15 at 20, this one you can consider. So that is how, that's it. That's it. So that is how it is structured. So when you go to the chart section and you see the quote estimate, these are real figures from Prudential Life. So once you get that, you can tell me, hey, Alex, I need whole life insurance of this amount. You'll have an idea. My budget can only allow me 30,000. Let me know the numbers, right? I can help you with all that. So my number is there and the email is there. So the other one is start your whole life insurance. If you cannot text me, there's a copy there. There's a link to a Google Sheet where you can fill your details from your age to the sum, to the amount you want, the sum assured. Do you want critical illness? It's all there. Then I can be able to attend to you, right? So I'll make things easier for you. Then we have other resources. Remember, I not only talk about protection, but about how to manage your money, how to invest it, how to grow, and how to distribute it in a safe way. Now, let me see a few questions. All right, allow me to go through this question. Is there a difference between life insurance and whole life? We have already answered that. Demystify between Prudential and Britam whole life insurance. Now, Britam, I'm not sure whether they have a whole life insurance currently. The company that I know, they have a whole life insurance that is close to Prudential Life, SICA Life. So I'm not sure about Britam whole life. But I know now, Daisy, you understand if we are talking about whole life insurance or we are talking about endowment policies. So most insurance companies, if not all, they're going to have endowment policies. Now, if a 50-year-old takes 20 years long life cover with critical illness and accidental disability cover, which sees at 65, will he continue to pay critical illness and accidental disability after 65 years? No. After 65 years, it's a no. The premiums, you're not going, it's either which comes first. Yeah. So after 65 years, you don't pay. Does critical illness benefit cover all types of cancer, especially prostate, breast, and cervical cancer? Yes, cancer is cancer. But now we can go into more details with that. But any cancer can be covered through critical illness. Oh, I hear volume is low. I hope, have you been hearing or I've been talking to myself? Give me a thumbs up if you've been hearing me, just to know if you're around. Amazing. I see. Good, 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 good. That's nice. Which insurance company would you recommend to give the best whole life insurance? We say Prudential Life. Currently, as things are, is the best. One, it has been in the market for over 175 years. They have made their errors. They know how the business runs, right? It's the fourth biggest life insurance company in the world. So they have enough assets to compensate their people. Their claim ratio is over 98%. So we are talking about reputation. The company has been there for ages. So that is what I use. That is what I recommend. The irony is we are very quick to protect our properties, vehicles, houses, equipment, but hey, look at this way. Imagine you can pay for that car. You can pay for third-party insurance over 150,000, 200,000 without fail every year. You can protect your car, but you cannot protect your children or you as the asset. You are the asset. Your car is an asset to you. So if your car is affected, you become financially affected. You are an asset to your family. If you become affected, your family becomes affected. Protect them with a 10,000. If you are paying 200,000 for your car, why are you not paying whole life insurance? Now you know. On mortgages, you mentioned the bank is paid against my life insurance in an event like that. Yes, that is why you rarely see now the banks come, and foreclose your, mortgage, your home, if one passes on, because they have a life insurance to guard against that, right? All right. Does it mean family keeps the property? Yes. Can one take last expense insurance for their parents? Yes. Even your in-laws, your siblings, you can be able to do that. Yeah. Currently, the one of the best last expense insurance company, APSA is having one. APSA, they do have very nice one, last expense cover. So Akipesa investment is really emotional. Okay, yeah, that one. How do we determine the financial soundness of an insurance company? I think I have tackled that. Does it mean that if I'm found to be unwell with a disease like blood pressure, they won't insure me for whole life? No, 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 no. They are going to insure you. Now we say that anything about 8.5, I gave you, let's say a loophole. If you have this, 8.5 is good. Yeah, that's an entry point. You don't need any medical test. Yeah, but also in your form, you don't lie. If you have this ailment, if you have these health conditions, you don't say no. If you say no, you be lying. It's against the principle of utmost good faith. So what happens if you have BP, if your BMI is high, if you have arthritis, if you have any lifestyle diseases, hypertension, your premiums will be more. You're going to pay premiums, more premiums than a person who don't have. So you're still insured. Now, if you engage in risky activities, they are still going to insure you, or they are going to consider your risk level. Then what happens is you pay more for that risk. So you disclose, then they weigh the risk, you pay more, or they say, you are so high of a risk for us to insure. Okay. All right. Also, is it wise for a person in their 20s to start investing in a trust fund? All right. A trust fund, one advantage that it gives you is that there's no probate. Mostly is usually good. Now, if you have some beneficiaries and if you know that if you're not there and they are not accessing the cash and the liquidity that you had, they are going to suffer. That is when a trust fund. But now there are two types of trust fund. There's a cash trust fund. Cash is the simplest. The one I was talking about is a cash trust fund. There's another complex called family trust, where you can transfer all your assets there, your car, your land, your house, everything that you owe, even your bank account, the name is for that family trust fund. It means you are buying assets and holding assets under the name of that trust. If you can be able to initiate that, the better, because it means no succession planning, no probate, no court system. Your family transition after you is smooth, right? All right, I read somewhere, I guess, on Prudential website, there is a combined whole life insurance product for both spouses. Yes, there's a joint cover that you can have. Instead of you taking a standalone life cover and then a spouse, you can get a joint life cover. But now I usually discourage that one. Why? Hey, maisha ni mbaya. We have seen people divorcing. Let's go to the worst case scenario. We are not mincing words. If you divorce and you have a joint whole life insurance, you cannot divorce a whole life insurance. Mshamaliza 10 years, so mko together, right? Now even changing the beneficiaries become a trouble. Yeah. So individually you are flexible, right? Then also it also means whoever passes on first, the other one gets. Now, the other one is not protected. If they need a whole life insurance, they'll have to take another whole life insurance. In case of critical illness, it's a first come, first serve basis. So if it pays one spouse, one partner, it expires. So you have to take another one. So the best that I usually recommend is take individually. Is the best. Although we have that that exemption, yeah. Where are these documents you are referring to, Alex? Lots of financial literacy materials come in handy. Yeah, they are. Go at the top of this chart. All right. Someone has said, Britam, let me see. Kindly enlighten us how premiums are invested by the insurance company to get such a huge return. Yeah, I've been asked about that. But how insurance? Where are they investing this money? You're going to, we say that they create money like from nowhere, but we understood that it's a pool of resources for many people. But now they don't hold that money in a pool, in a bank somewhere. They invest it. Remember, the probability of someone dying is low. In fact, the average life of Africans, forget about what they tell us in the website from these Western standards, we live probably closer over 80 years. Let's say 80 years. The average life, they usually say is 76 years, but it's considered 76. Now, if the majority of people will exit the planet when they are 76 years, and they took the life insurance product when they were an average 30 to 40, if you take that amount, now take a compound interest calculator. Yeah? If you take a compound interest calculator, let me even, you're not going to take it. I'm going to show you here a live example. Now, this is a compound interest calculator. Now you have zero. You are contributing 30,000 to your whole life insurance. The insurance company takes that. Remember, these are institutional investors. They are not getting your 10% in the money market fund. They can negotiate. That is why you usually see, even when buying bonds, they are doing something we call competitive bidding. They can get a higher interest rate compared to you, a retail investor. So let's take example, they're investing in 15%. You are 35 when you got your policy, right? You are 35. Now you exit when you are 80 years. How many years are those? 35. Those are 45 years. So in between that period, this 30,000, you paid for how many years? Let's say you paid it for 15 years. By the time you are done paying, that amount it's 19 million. That is 19 million. You are not paying anything else. So let's assume now you take 80 years minus 35 minus 15 that you have paid. That will be 30 years. So they're going to extra invest the 19. So we take 19 million. Here is 19,600,000. You are now not contributing. Then they are still earning 15% and they have extra 30 years. Okay. Is this real? Okay. This is 1, 2, this is 19 million. Contribute 0, they earn 15, they have 30 years. Hey, do you see the kind of money that will be? I have to repeat. This thing, 19.6 million. It is too much. 19,600,000. They contribute nothing. That is what you will have. That money would have grown after 16 years, after 15 years. Then they earn an interest of 15%. and they're still investing it for 30. That is 1.2 billion. And they were paying you how much? They were paying you probably 30,000, 30 million. They were paying, they are going to pay your family sum assured plus bonuses. Let's say 50 billion. Ha, now you know where they invest. That is settled. That is well settled. All right. Can I get the Excel sheet? Yeah, the Excel sheet is there. You just click. Yeah, can I increase the premium paid if my salary increases? Yes, you can. Within 1 year, that is possible. But I usually recommend, in case you take a whole life insurance, that is probably 10,000. Then after 1 year, 2 year, your income increases, you can take another whole life insurance. You just take another one. That's it. Case closed. Yeah. All right. You take on taking a loan against life. Yes. Now you can use your whole life insurance as a collateral. Remember, we said whole life insurance have been used by institutions to safeguard mortgages, to safeguard credit. So it means wewe usipotulipa hata uhepe, in case you ever die, the minute you die, that life insurance part of it, the one that you had guaranteed, insurance company will pay direct to that lending company. So you can take life insurance. Of course, they don't guarantee the whole thing. They'll give you probably 50, 60% of the sum assured, right? You can use it as a collateral. Oh, okay. I see there are people who cannot be able to see those documents. Let me share it. Let me share those documents, those links with you. I believe you are learning. If you are learning, give me some excitement. Give me an emoji there. All right. Expound on, amazing. Expound on the 6 months waiting period and the reason for the policy to cover against death. Now, one thing that you need to note is when you take a whole life insurance, there is usually, we said below 8.5 million, you are not required to undergo medical. But there is a price to that. There's a waiting period of 6 months. Now, if you want to scrap the waiting period, you have to take yourself for medical test. Now, remember, above 8.5, the insurance company will pay for your medical. But below 8.5, you don't get, it's not required for you to go for the medical, but you are required to wait. You have a waiting period of 6 months, right? But if it's an accidental death, they pay immediately. It has no waiting period. So above 8.5, because you are going for medical, there is no waiting period, right? So that one has changed. Earlier, Prudential had a waiting period of 6 months, even after medicals, but now they don't have the waiting period unless you are 8.5 and below and you have not taken the medical test. All right, I think, and he has assumed that the 30K was not being invested for the 15 years. No, what I did is you are contributing now for 15 years, right? So I took that 30,000. Insurance company, when they receive your premiums every month, they invest it in an investment that is giving them. We assume 15%. So in 15 years, how much would that money have grown to? We saw it is 19.6 million. So now, after 15 years, we're not going to be contributing. So we take that money and leave it in that account. So after 30 years, how much will they have? You can do that computation. Me nimeona billions. Go do it. If there was an error, let me know. I'm going to do it again to see whether that was true. All right. I think I'm done with that. Now, let me open the floor for a few of you to ask the question. Grace, Godera, where are you? You can say something. Then someone else with a question can chip in. All right. Any question? Or the presentation was so clear that you have no questions? All the questions have been answered. Just unmute and ask your question. All right, all right. Someone is saying, I have exhausted. All right. Now, here's the next action that you need to do. One, if you have a whole life insurance, think about insuring your spouse. Very important. Two, if you don't have one, I'm going to help you get one, right? And we have agreed that I usually commit Prudential Life. So when you're coming to me, I'm going to take you to Prudential Life, right? So I think that's it. That marks the end of our presentation. So using your emails that you provided, I'm going to share a recording of this video. Also, I'm going to share also those links that I was telling you about. Well, I want to thank you for turning up for this session. Now, when you know that knowledge, please don't allow that knowledge to be, to die with you, or you come and, you get your whole life insurance and then you keep quiet. This is mine. No, please tell your brothers, tell your sisters, tell your friends about this message so that we safeguard.
Alex, there's a question.
Yes, go ahead.
Can you have more than one life? Can you have more than one whole life insurance?
Yes, Jacqueline, you can have more than one whole life insurance. Now, look at it this way. When you're applying for whole life insurance, there's a section where they ask probably your net worth. How much are your assets? How much are your liabilities? You cannot be earning that your income is 50,000 and you want a whole life of 100 million. Ai, wataona hapa kuna mchezo. Huyu jamaa kwa anataka kujitoa uhai. This guy want to kill themselves. It has to be, what can I say? Iwe reasonable. It has to be reasonable, right? So the life of a person has no measurable monetary value. So what we try to hedge to, we try to give it economic value, right? So you can take more than one whole life insurance. That is why you can have 10 endowment policies. It is the same way. You can have more than one whole life insurance, right? So some will ask, can I take from different companies? Yes, you can have one from Prudential, you can have one from ICA, or any other company that can come, right? So we have agreed that go tell your friend, at least do one thing. Tell one friend or tell your sibling or one person you know. That will, hiyo itafanya maisha yangu iwe rahisi, yeah? Because I want to help at least 1,000 families get a whole life insurance. When I hit that mark, nitakuwa nimesikia I have saved 1,000 families and generations to come. So let me bid you good night. Thank you so much for turning up for this session. The next session probably will be an investment session. I'm also going to invite you for one. And we also have a WhatsApp group. You can join it, where you'll be receiving my, updates on these things: investment, whole life insurance, protecting yourself, trust fund, and all that. So thank you so much and have a good night. I appreciate you.